Deep Dive with David Stendhal, where we trade without ego, no emotion, no greed, and no opinion. Before we begin tonight's video blog, please read over our trading disclaimer and remember to trade smart and accept the reality that trading futures is risky. This presentation does not provide buy-sell recommendations, and our information is strictly provided for educational purposes only. As always, trade at your own risk and analysis. Hey, it's David Stendhal with tonight's Deep Dive. It is December 28, 2017, and tonight I'm going to talk about the S&P 500 just a little bit, and then I'm really going to focus on the Russell 2000. So we've not added the Russell to the normal Deep Dive, but the numbers would be fairly similar, so bear with me here. So the short, intermediate are pointing to the upside. The long-term trend is wavering a little bit here with the S&P 500. The seasonals are still, the seasonals are still bullish, and the technicals are still on the upside. If we actually take a look at the patterns, which is where we've actually added the Russell 2000 with the ETF being IWM, and then I also added heating oil. We'll update this information as well. But the Russell has a lazy day 17. I don't really talk about that one too much, and so that's really what I want to focus on in a combination between the Russell and the S&P 500. So if we take a look at the actual market itself, this being the Russell, the lazy day, you can see on these daily bars here for the Russell that the bars here are blue, which obviously differentiates them from the traditional green bars, and the blue bars represent a quietness to the market. The market has neither gotten overbought or oversold. They've been in fair value, and they've been in fair value for a while. This is a little bit different from a volatility consolidation phase, but it's similar, but the range is a little more broad when it comes to the lazy day formation. So you can see here, because I've got a couple of examples here. We've had 18 bars. You can see the 18 right there. The last bar, it surges and then retraces. We have another case here. We had 23 days in a row. It surges a little bit and then retraces. Here we are right now, and we're on day 17. It has not concluded as of yet. The market is just very, very quiet, and traditionally when you have these phases, you'll have a surge. The surge can amount to something, and sometimes it doesn't. And what you're really looking for is an expansion. You're looking for a volatility surge in the market, and sometimes when you break above these past periods, you have a surge one way or the other. In the last two cases, they've been to the upside, but they've not necessarily held. And so it's a type of case where we consider it an environmental type change, and that's why when we look at this, the lazy days are found under the environmental change. And the upshot of all this is that the market is due for some type of an increase in volatility. It doesn't tell us direction. It just simply tells us that the market is due for some type of a volatility surge. Now, the reason I mentioned the S&P and the Russell is that if we take a look at the S&P here, and what you'll see, while this one's coming up, I'll just bounce back here. You'll see that there was a stretch high in the S&P 500 3 trading days ago, and that amounts to something that's telling us that the market has gotten ahead of itself and is likely to reverse. I mentioned this, I think, in a deep dive just a couple of days ago. It's not necessarily saying that the market's going to sell off, because the S&P in particular and the Russell are just extraordinarily strong markets, especially in the phase that we're in right now. This little hash mark here, this magenta hash mark, is the one that I'm referring to, and because of this, the market has traditionally, you'd expect it to sell off, but as is normally the case in the S&P and or the Russell, for the most part, the market has moved sideways. And because we have the Russell in that lazy day formation, that is something that we just simply have to be aware of and expect some type of a surge. And in many cases, because of the fact that the S&P has had that instance where the market has essentially shown us that it wants to sell off, you really have to be very, very aware of trading the S&P and or the Russell right now. The other thing I want to point out, and I'm just going to pull this back up while we wait for it, is going to be some of the tendencies flipping back and forth between markets. But you can see here that the in this case the S&P 500, traditionally what happens is about now the market has a tendency to sell off a little bit in the S&P 500. We have this rally that traditionally occurs in the S&P 500 and or the Russell. The market has a tendency to peak, and then the last couple of days it does sell off just a little bit. When we look at the 5-year notes or 5-year tendencies, the same thing happens with the 10 years. There's a little black triangle that is overriding the data right now, but it essentially is telling us that it peaks about this point in time and then sells off. You can see it a little bit further here that they have the 5, 10, and 15. Here is the 5-year. It sells off a little bit to the end of the year. Same thing with the 15, and same with the 10 years. So bear in mind that any surge that we've seen thus far towards the tail end of the year, and we're essentially there right now, we have one more trading day, that we're probably going to see the market just simply move sideways, consolidate a little bit in the beginning of the new year, and it's basically mid-January. Understand that, mid-January, that we really start to see the market start to rally again. So what I would have you do is just simply be aware of the fact that the markets in general are a little bit quiet, and we're looking for instances where the market is likely to, at least as a minimum, move sideways in both the S&P and the Russell, and we're seeing a lot of conditions where the market is just extremely overbought in both markets, at least when it comes to the weekly charts, both S&P and the Russell, and we would expect the market to take a little bit of a breather here. And then this breather, as the seasonals are pointing, could amount to the mid part of January before they really start to pick up again in either of the two markets. As it stands right now, the S&P is flat, meaning the systems, and the Russell is still long, and it's long with a weekly system as the beginning of December. So the way that we're playing this out is essentially we are gung-ho long the market, feeling very comfortable with how things are playing out, but we're cautious here in that the market is due for some type of a reversal, not a bear market, but a reversal. And a lot of the instances in the recent past in both the S&P and the Russell, these reversals have not been reversals, they've just been sideways consolidations. But whatever the case is, we're keeping a close eye on the systems, and from that standpoint, we realize that specifically when it comes to the deep dive, and we look at the Russell and the lazy day, with the 17 days of continued sideways non-volatile conditions, that it is a ticking time bomb. Something is going to explode, and it could explode to the downside, or it could have an explosion to the upside. And if that does happen, it could be short-lived, as has been the case in recent conditions. So keep in mind that that these conditions are actually out there. Keep a close eye on your positions, and for our side, we're obviously bullish the market with the systems, but nonetheless, we're expecting some explosive moves here, because when you have a condition like this in the Russell, it can only stay in a quiet period for so long. And traditionally, when those conditions end, they end with an explosive move. So bear that in mind. We had a condition like that just recently in crude oil. So the same condition is now set up here in the Russell. So that's tonight's deep dive. We'll take a look at some more markets later on, and we'll go from there. Thanks for watching.